Well, if you look at the production figures out of the US, not a great deal actually, because in January, start of the year, obviously very cold start to the year in the US, you actually saw a dip in actual US production down to about 13.2 million barrels a day. A lot of the focus of the administration at the moment seems to be on external competitors in the oil market, and you mentioned the tariffs, secondary tariffs on Russian oil sales, buyers. You've got to put that in the context of India and China. Both bought about 2.6 million barrels a day of crude last month from Russia, and these are major drivers for the oil market, both China and India. So these tariffs and the threat of these tariffs, the threat of more sanctions on Iran, Venezuela, this is going to displace a tremendous amount of crude if these come into action. And there's so many moving parts now in the oil market. I can't really remember a more complex period, certainly in the 25 years that I've been doing this job.
That's saying a lot, because you've been through a lot.
There's just so much change, so much uncertainty, so much volatility in these markets. And maybe that's reflected in what we're seeing in crude markets at the moment. I mean, Brent futures have been on a tear. You know, from the doldrums, low 70s, we're now ticking up, $74 a barrel today. Okay, it's eased off a little bit, but there's just a huge amount of uncertainty in the market.
You know, it's interesting, you talk about all the uncertainty and the move higher we've seen in oil, but when you look over the long term, the range is still fairly tight given the number of variables impacting markets. How do you explain the relative range-bound nature of oil markets when you look in a historical context?
Well, a lot of analysts talk about this sweet spot for consumers and producers, and I think that a big part of that is as well the United States. You know, remember 20 years ago when there was a lot of tension between, say, OPEC and the US over oil prices. The US wasn't a major exporter of crude. It wasn't even a major producer. Now we're at 13.2, 13.6 million barrels a day, major exporter. You know, if you look at the US balance of payments deficit, where would it be if the US wasn't exporting crude? So, you know, the US benefits as well from higher oil prices, and this is in many respects the paradox that the administration finds itself in, because you have drill baby drill, you need higher oil prices to justify that as well in the US, because the oil industry is highly commercially sensitive to debt markets. It has to be more profitable. So, you know, $70 a barrel is going to get you there. $50 a barrel probably isn't. You know, that's going to be hard if you're drilling in West Texas and doing shale. Whereas in OPEC, you have lower production costs. You can kind of survive that, although for all these Gulf economies, you know, they have high spend, high fiscal break-evens.
But then at the same time in the U.S., even though you are an exporter, you also want lower prices at the pump for U.S. consumers.
Of course, yeah, because if you have that dynamic of higher prices weighing down on consumption, and you know, it's this balance between supply and demand always, then that's going to be negative for markets. So I think that this $70 a barrel sort of range seems to be the sweet spot that works for the major consuming nations, seems to work for the US at the moment and President Trump, but doesn't impact the industry's ability to grow. And we've seen that in non-OPEC production, which is rising. You know, we had the Castberg field in the Arctic come on stream yesterday. That's another 220,000 barrels of light sweet crude coming into the Atlantic Basin. And we've had Tengiz last month, another 260,000 barrels a day of lighter crude coming into the Mediterranean. So non-OPEC supply is actually doing really well at the moment.